So thanks everybody for joining us this afternoon. One of our regular webinars. Really great to have Peter Lucas with us. Peter's from Kestrel Solutions. I've known Pete for probably the last, certainly the last 15 or 16 years, and he's a consummate performer in his area. Pete's been working in the turnaround space for the last 34 years and has been the owner of Kestrel Solutions for the last 15 years. And Kestrel Solutions, Pete will tell you a bit about more in a minute, specialises in business improvement, especially in the turnaround sector. So, got a great presentation from Peter tonight. I'll hand over to him now, and I hope you enjoy it. Thanks, Pete.
Thanks, Russ, for the opportunity here tonight to speak to you all about the 11th and what I consider the most important commandment. As Russ said, I've got 30-odd years in the turnaround and business improvement space, and we've worked with clients across a wide range of industries, from small businesses to medium-sized businesses with $20–30 million turnovers. So hopefully we'll be able to give you some insights. And I suppose I want to start with just to begin with, we know all owners want to be successful, but I'd like to ask the question, get some feedback as to how do we define a successful business? What does a successful business, what does it mean to us? So if I get some feedback from you all as to how you would think or define a successful business. Just maybe type that in the question area. The one from Glenn saying one that makes money. The ability to sell your product from Sue. Makes a profit from Bron. So we're seeing a variety of definitions, and a happy business. I think what we can conclude from that is that at the end of the day, there is really no universal definition of a successful business. It varies from people to people. But what I want to try to give you a definition. A typical lawyer type definition is that a business is successful if it's not failed nor is failing. So I think any business that hasn't failed nor is looking like failing, I think is being regarded as being successful. So let's define failing. This comes from a book by McRobert and Hoffman back in 1997 about corporate collapse. And it says, failing to provide from its main operating business a sustainable return at least equal to that which is required of the enterprise by its sponsors without, and this is very critical, without a requirement for continual injections of additional funding. And I see in my line of work over the years so many businesses where the owners are continually tipping money in. And I wonder, why do you want to be tipping money in? Isn't the aim of being in business from a financial perspective being able to take money out to build your wealth and to be able to enjoy life? So this definition is different from insolvency. This is a definition I think that's most applicable to businesses in trying to move forward. And as a result, people should be looking to getting a decent return without injecting funds. There's been hundreds of books and articles written about how to have a successful business. I've got a few covers there, all very good books. But I think the reality is that for small business owners who are tight for time, there's too many books for business owners to read, absorb, analyze all this material that's around, hundreds and hundreds of books, to help them come up with a simple formula to follow. A lot of them got very common themes, but they do take time to read and absorb and try to figure out the little differences in the way they've been written. So I want to give you something that is simple, easy to remember, and something that you can follow. And my simple rule in the 11th commandment is watch thy cash flow. It is the imperative in running a business. And I'm going to explain why and give you some tips of how to do it. And if you've got questions along the way, please type the question and I'll answer them. So looking at cash flow, give you a formula so you remember. Net cash flow equals your cash inflows minus your cash outflows. Very simple to remember. So what's our cash inflows? It's all the cash from sales, proceeds from asset sales, capital injections, and loans taken out. Cash outflows equals all your payment of business expenses, capital expenditure, payment of taxes, any dividends to shareholders, loan repayments, and returns of capital. So what we want is to look at, you should be monitoring, what's your net cash flow? What's the cash inflows minus your cash outflows? And we want in a successful business that net cash flow to be a positive number, where a company produces more cash than it needs to sustain the business. We want that ideally without having to be going to the bank and using your home or other assets to borrow money to inject to give that number. So we want the business to be generating itself a positive cash flow figure. So remember, positive net cash flow. So the reality is that many businesses have gone broke although they've been profitable. The reason is they run out of cash. 34 years of what I've done, I've never seen, heard or read about a business falling into insolvency that has consistently generated a positive net cash flow and being able to retain sufficient funds in there to sustain itself into the future. I've seen groups where one company's been very strong cash flow, but that one company in there is funding others, so it ends up going broke. But in isolation, no. But plenty of profitable businesses have run out of cash, businesses with great vision and ideas that have run out of cash and have failed. So looking at it, we need to consider how do we generate consistently a net cash, positive cash flow. It is by the way we manage our business. And what I want to do now is give you tips for improving your cash flow so that your business will be successful, less stressful, and you'll be able to move forward to achieve your goals. We need to constantly manage the cash flow, and I'll come and give you some tips of that. So one of the first things we need to do when looking at cash flow is we need to consider in our business decisions, what are the implications? What's the cash flow implications of the decisions we're going to make in the business? Remembering our net cash flow is cash inflows minus cash outflows, and we want that number to be positive. So what do we need to do making decisions? In making our business decisions, all our business decisions, will that decision increase our cash inflows? Will it reduce our cash outflows? Will it do both? And is it immediate or down the track? And how do we make good decisions? We should be thinking about what the cash implications are. If we incur some capital expenditure, what will be the cash implications down the track? We may not get the money immediately, but we will get it down the track and get more than what we've expended. Too many times I see businesses that don't think about the cash flow implications. So that's the first thing. Think about any decision you're making, will it improve our cash flow? Another tip for you is looking at our products and services. Which of our products and services generate the most cash for our businesses? Do you know where you generate your cash? What's your cash cow? Do we have products and services that cost us money? Loss leaders. Are the loss leaders really generating or helping us generate the business that produces our cash? Or is it really just draining cash? If you don't know, you need to find out. You need to go back and look at where you're getting your sales and what generates the cash, what costs. And it might not be the one that produces the most sales. That could in fact be one costing you. But where's the profit margins? Looking at those things will move forward and help you generate positive cash flow. Do you prepare budgets? You should prepare a revenue budget and separately prepare an expense budget. What are your overheads? What are your wages going to be? Then combine the two. And how does it look? Are we making a profit? Are we making a loss? The reason I say to do revenue separately from your expense is it's too tempting. I've seen it so many times as people are going through their budget and they're seeing, particularly now with Excel and other spreadsheet modeling, where you can see the results as you're producing it, and people suddenly go and start changing revenue figures, changing expenses to start trying to create a result, rather than looking at what are our expenses, what do we think our revenue is going to be, is it good? Then you convert it to a cash flow. And I'll come a bit more into that in a second. But one of the critical things is that you need to record your assumptions. What are the assumptions you've made in generating these numbers? What are the underlying factors? And are they realistic? I was at a client's the other day and we were talking about their budgets, and I said to them, I can give you a budget that will give you a $100 million profit. I can give you a budget that will give you a $100 million loss. Because that's just numbers on a piece of paper. The underlying assumptions are what are critical. Are they realistic? Are they achievable? Preparing a cash flow. Cash flow is different from a budget, but they should be linked. Cash flow looks at your timing of receipts and payments. Your budget is looking for more from a straight profit and loss perspective. So your budget won't contain things like capital expenditure, it won't contain GST, it won't contain loan repayments. That's your cash flow. And you're looking at your timing of when receipts are going to come in, when do you need to make your payments. If you're on a quarterly BAS, then it'll show you payments at the end of the month after each quarter. Same with your superannuation. It'll show you loan repayments. You should factor any capital expenditure you're planning to make. When are your debtors paying? What's the tradition? Don't always think they're going to pay 7 or 14 days. Some are going to be late payers. Some might be on 30-day accounts, which means they'll be a month after you've incurred the invoice. Sometimes they might be 30 days from the end of the month. And if they're a bit slow, so you've got to factor those things into account. Preparing your cash flow. Each month, you should compare your actual cash flow to your forecast. What I do in my business is we run a 3-monthly rolling cash forecast. Each month at the start, we predict what cash is going to come in over the next 3 months. And I know because of the nature of my business, what I'm going to have to pay out over the next 3 months. I do that each month. One of the very good tips you can have is in your cash flow, you can go weekly for, say, the first 8 weeks of the cash flow, the first 2 months. What we do, because I pay wages twice a month, once on the 15th of the month and on the end of the month, my first month is broken up what cash receipts are coming in pre the 15th and what goes out what's going to come in post the 15th. And I know what I need to make what periodical payments will be coming out, what wages are going to need to be paid. So I do that. Another way is maybe to do it out 2 months, depending on the nature of your business, on a weekly basis. I don't really recommend doing it daily because you can generally manipulate things around to whether you're paying something on a Tuesday or Wednesday, etc. Weekly is good enough detail. But comparing what actually occurred to what you predicted, you start to learn how to manage that cash flow. Are your predictions right? How do we need to manage our creditors, etc.? Another way to improve your cash flow is about reducing costs and managing your costs. Comes back partly to that decision making. Partly it's about setting budgets so people actually know within the business what they can spend or what's the target. Reducing costs can be dangerous if you're having a downturn because cutting costs can lead to a downward spiral if you cut the wrong costs. But we go a bit beyond just a simple straight cost cutting of wages and things like that, because you need to analyse the business, see where costs can be saved, but you also need to look at the improvement. How can you improve the efficiency of the business? What things can we do? What's the systems and process that we could do and improve on to do that? And we use some concepts developed by Toyota around a thing called 7 wastes. They identified 7 areas which creates waste, and waste they talk about as being things that do not add value from a customer perspective. So they're things like overproduction. Where do we produce too much? Products, material, scrap. And even though they're a manufacturer, it can be applied to any type of business. Where do things sit and wait? Often it's in the boss's in tray. So where are things waiting for decisions even? Not just waiting for the next process, but waiting for decisions, waiting for things to come in. Transportation, where do things move around the business? So it's not just your transport costs and courier costs, but things moving around the business. Inappropriate processing, wrong people, wrong equipment for the job at hand. Inventories, building up of inventories. Surprising how much old stock businesses still have and haven't addressed, written off, and maybe even find a way to turn that into cash. Motion, poor ergonomics, and workspace layout. And of course the last one, defects, a simple one, errors and rework, refunds, poor quality warranty claims. Very much an area where there's a lot of waste in businesses and something you can move and look to improve. How do we reduce errors? How do we improve quality? It's an area we do a lot of work in, and it's an area we really specialise in helping businesses identify inefficiencies and help to rectify that. I've just done one for a large licensed club, and we're in the next week of meeting with the CEO to sit down and put teams together from what we've come up with. And we've got 5 project teams that are going to move forward to help improve the efficiency of the business. You improve that efficiency, it can have enormous impacts on profitability and cash flow. Particularly, that's really important in times when revenues are stagnant. And we've got a low growth economy at the moment. It's not easy for businesses to grow their top line organically. So how do you improve your profits and cash flow? You've got to become more efficient. And that's one of the problems that Australian manufacturing has had, is besides a high cost base, is have we been as efficient as we can? Can we become more efficient? It's an area where I really think most businesses really need to focus and work out how they can become more efficient, eliminate the waste. So moving forward, I think there's 6 key points for cash flow management. 1, you're aiming to be positive net cash flow consistently, year in, year out. You may not be able to do it every month, particularly if you have seasonal factors or you're in the construction game when you're going to close down in January. That can be difficult, but you need consistent positive cash flow. You need to consider the cash flow implications of each decision you make. Do your budget. I know people don't like doing budgets because they've got to make predictions. You need to, and you need to then convert it into a cash flow, which you can manage. You need to know which of your products and services make your money for you. And if others aren't, maybe you should consider exiting those products. Monitor actual cash flow against forecasts. Did you achieve your targets? Why not? The why not is a really important question. Understand why you've spent more than you had forecasted. What was the reasons? And then you need to reduce costs and reduce inefficiency in your business. They are my 6 key points in managing cash flow. I want to ask a further question. 3 choices of business. A business with turnover of 300 million, but with a very small profit and negative cash flow. Second business, profitable, but a low turnover business with limited cash generation. The third business with a low turnover, lower turnover still, but generates good cash flow, good cash generating business. What I'd like you to answer in the question area is, which one of the 3 would you like to have? Is it business number 1 with the big turnover and a negative cash flow? Business number 2, a lower turnover which generates limited cash? Or even lower turnover business that generates good cash? Which would you like? Sue's 3, Glenn's 3? Ron's 3? Brad's 3? Pretty universal. Yes, the third one's the winner. Question I've got for you, which one are you at the moment? Don't want you to write an answer in, but I want you to think about it. Where do you sit? And how can you make more cash out of your business? We're happy to help you. So, give you a summary. No universal definition of success. For me though, if you're not failing, and remember that definition earlier about providing a return that you want as the owner of the business without you having to continually put cash into the business, you're not failing. If you're failing if you're having to put cash in and not going to generate that return. So success is about not failing. The one rule, watch thy cash flow. nothing else you do but constantly monitor your cash flow, you're going to head in the right direction. Think about the cash flow implications with each decision. Remember those 6 other points. Let's look and see how you can improve, get your budgets, okay? So that's it for tonight. Thank you for attending. I hope you've got something out of it. Happy to stay on and answer any other questions that people might have.
Okay, thanks, Pete. Thanks, everybody. I can't stress enough the importance of cash flow in business. You know, as business consultants, Pete and I see this all the time. Businesses that just run out of cash, you know, and cash is the blood that flows through your business, so really important. So really appreciate Pete coming along and talking tonight. It's normally a bit of a dry old subject, but thanks for livening it up for us, Pete. Any questions?
And look, Russ,
go on.
Russ, just before I can't, you're spot on, Russ. People can get, you know, vision and culture are very important, but without cash, you can't achieve any of that.
Yeah, I'd agree. I'd agree.
Yeah.
Now, if anybody of you interested in talking to Pete, please give him a call. His details are there on the number. I'm sure he's happy to have a chat with you, obligation free, and discuss your needs. Certainly go and see him at the website. So thank you very much again, and good night, everybody. Talk to you again soon.